In 2019, a company that rented out desks was valued at $47 billion. For context, that made it more valuable than Ford Motor Company, Ford, which makes cars. WeWork rented desks. They filed to go public in August of that year. By September, the IPO was dead. By October, the CEO was gone. By November, the company was fighting for survival. $47 billion, 8 weeks. This is not a story about a bad idea. The idea was fine. This is a story about what happens when the idea stops mattering, and the story about the idea takes over. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey in New York City. The concept was straightforward: lease large commercial spaces long-term, subdivide them and sublet to startups, freelancers, and small businesses on flexible short-term contracts. It was, in the most technical sense, a real estate arbitrage business. Buy long, sell short, capture the margin. Property managers had been doing versions of this for decades, but Neumann understood something important about the moment he was operating in. Silicon Valley was drowning in capital. Venture funds needed to deploy billions, and they were not looking for real estate companies. They were looking for technology platforms. So Neumann gave them one, in pitch decks at least. He called WeWork a community company. He spoke about elevating the world's consciousness. He said WeWork's mission was to create a world where people work to make a life, not just a living. The investors nodded. The checks cleared. By 2014, WeWork had raised over $150 million. By 2015, SoftBank was circling. By 2017, SoftBank's Masayoshi Son met Neumann, spent 12 minutes touring a WeWork space, and reportedly committed $4.4 billion. $12 minutes. Son had a philosophy. In a world of exponential change, the biggest risk was not moving too fast. It was moving too slow. He called it the information revolution. He had $100 billion in his vision fund, and he needed somewhere to put it. WeWork's valuation went from $1.5 billion in 2014 to $20 billion by 2017, then to $35 billion. Then in January 2019, after another SoftBank investment, $47 billion, the company had never turned a profit, not once. In 2018, WeWork lost $1.9 billion on revenues of $1.8 billion. That is not a business metric. That is a magic trick. They were spending more than $1 for every dollar they made at industrial scale and calling it growth. The offices looked extraordinary. Craft beer on tap. Exposed brick. Curated playlists. The brand was genuinely seductive. Membership grew from 50,000 in 2015 to over 400,000 by 2018. The product worked. The economics did not. And then there was Adam Neumann. By any measure, a remarkable salesman, charismatic, visionary in his self-presentation, and completely unbounded by conventional thinking, or, as it would turn out, conventional corporate governance. Neumann had taken out personal loans secured against his WeWork equity and used some of the proceeds to buy properties, which he then leased back to WeWork. He was, in effect, his company's landlord. The board was aware. The board said nothing. He trademarked the word "we" personally and then sold the trademark back to WeWork for approximately $5.9 million. The company paid its own CEO nearly $6 million for a word. The board approved it. Of course they did. Neumann's shares carried supervoting rights, reportedly 20 votes per share. Institutional investors had 1 vote per share. In practical terms, Adam Neumann was not the CEO of WeWork. He was WeWork. No check, no balance. He flew private. He reportedly smoked marijuana on a private jet flying to Israel where it was illegal, then had staff remove the evidence before landing. He kept a surfboard in his office. None of this is metaphor. All of it is documented. In late 2018 and early 2019, the company began preparing for its initial public offering. This was the plan all along. Go public, let early investors cash out and use fresh capital to fund the expansion. It was, on paper, a clean exit. Then they filed the S-1. The S-1 is the prospectus document a company submits to the SEC before going public. It is, by law, a comprehensive disclosure of the business. WeWork's S1 was, to put it mildly, comprehensive. It ran to over 350 pages. It mentioned the word "we" 1,700 times. It included a definition of community-adjusted EBITDA, a metric WeWork had invented themselves that excluded most of their actual costs. Wall Street analysts read this and reached for the aspirin. The prospectus revealed Neumann had sold approximately $700 million worth of his own WeWork shares before the IPO, cashing out while asking public investors to buy in. It revealed his wife, Rebecca, would help choose his successor if he died or became incapacitated. It revealed the company had $47 billion in long-term lease obligations on its books against a far smaller cushion of committed member revenue. The structural mismatch, long liabilities, short assets, was not hidden. It was there on the page, every word of it. The market reacted the way markets react when they finally read the room. The IPO valuation estimates collapsed from $47 billion to reported $10 to $12 billion. Then investors said even that was too high. The IPO was pulled entirely in September 2019. Within days, Neumann was pressured to resign as CEO. He was replaced by two co-CEOs, Artie Minson and Sebastian Gunningham, who immediately began assessing just how deep the damage ran. It ran deep. The company was burning through an estimated $700 million per quarter. Without IPO proceeds, it had weeks of runway. SoftBank, which had helped create this situation by inflating the valuation for years, now had to rescue it. In October 2019, SoftBank committed a rescue package worth approximately $9.5 billion, part new investment, part accelerated debt. As part of the deal, Neumann received a reported $185 million consulting fee and was allowed to sell approximately $970 million worth of shares back to SoftBank. The man who destroyed $40 billion in value left with over $1 billion. WeWork laid off approximately 2,400 employees, roughly 20% of its global workforce, by the end of 2019. The craft beer was reportedly removed from the offices. Some things, in the end, are not metaphor either. The company eventually went public anyway in October 2021 through a SPAC merger, a special-purpose acquisition company, which requires less disclosure than a traditional IPO. The listing valued WeWork at approximately $9 billion, down from $47 billion, a 80% haircut. 2 years later, in November 2023, WeWork filed for Chapter 11 bankruptcy protection. The company that was once worth more than Ford had liabilities exceeding its assets. It listed debts of an estimated $18.6 billion. SoftBank, across all its WeWork investments, reportedly lost somewhere in the range of $14 billion. Masayoshi Son called it a mistake. He said he had been fooled by Neumann's charisma. This is a man who runs a $100 billion fund. Here is the lesson, and it is not about coworking spaces. When a story becomes more valuable than the business, the people telling the story will do anything to protect the story. Governance exists precisely to survive the moment when the CEO believes they are the exception to every rule. WeWork had no functioning check on executive power. The board was compliant. The lead investor was enchanted. The auditors signed off. The only thing that stopped it was the one audience that actually read the document, the public market. And even then, barely. $47 billion is not a valuation. It is a consensus hallucination held together by the shared fear of being the first person in the room to say, "This does not make sense." Eventually, someone always does. It is just usually too late. If you found this one interesting, the story of Masayoshi Son and the full history of the SoftBank Vision Fund, how a single investor reshaped global startup culture and then watched it detonate, is coming next. Subscribe. More hidden empires are waiting.